So let's get started with, I would say, what I would call the impact of the new presidential administration so far. A lot of you, as Michael Fascitelli, to use his words, are not in the get-rich business, you're in the staying-rich business, right? So what impact does the Trump tax plan, for example, have on your business, what he's been proposing? Don, why don't we start with you?
Well, look, I think, by the way, the whole idea of being a good president is to be a good president for everybody. So while Mike talked about, well, you know, staying rich, I think we need to be a country and that promotes getting rich as well for everybody, and that should be equally dispersed, right? And by the way, I want to compliment Amir for having a panel that looks a little bit more like New York. Be nice to hear, right? So, because certainly women are a lot more active in the real estate business. So, with that said, the president his tax policies have the capacity to do some great things for us, for our industry. All of us have developed condos at one time or another, and so we create jobs, and a lot of jobs. And those of us who develop hotels create even more jobs. Well, just imagine that all of the revenue that we generate for condos are taxed as developers at the ordinary income level, 39% plus the regressive tax that we pay in New York State and New York City. So then again, somebody who goes and flips a GM building, holding it for a year, pays at the capital gains rate of 20%. And they create no jobs. In fact, to make that trade work, they've got to be more efficient, so they're probably going to cut some jobs. So that's a backward structure of our tax policy. So Trump's plan of putting a 15% tax at the corporate level, but also at the pass-through level for subchapter S corporations, limited partnerships, and LLCs, which is how all of us own our real estate, will then convert that income for condo developers to a 15% tax rate. What that's going to do to our business is stimulate far greater development, because as of last year, when I sat down with our accountants and looked at how much we were going to pay for construction in progress for condos, I said we ought to get out of the condo business. So I think we're going to see this tax policy create more activity. And then I think we should talk about deregulation at some point too, because I think his regulatory reform of financial services industry to stop crippling the financial services industry in terms of making sound investments with entrepreneurs and making good loans to entrepreneurs, that again I think is going to stimulate our real estate economy. And so he can be transformational for real estate, and I want to say for real estate.
One of the things about that plan, though, is that it's grand on ambition, but relatively light on details. Eliot, do you think it's something that can be actually implemented?
No, look, when you say it's light on details, I think that's a slight understatement. This was not a tax plan, folks. I hate to say it. And I agree with Don's initial point about we need tax policy that will be good for everybody, that will promote hard work and create the incentives we need. What they put out was a press release. Having been in government, I can tell you there's a difference between a press release you put out in a campaign and substantive policy. And what they put out was generated between Tuesday night and Wednesday when they realized they needed a distraction for the 100th day of his administration. It simply makes no sense. The numbers don't add up. It is bad policy. It will never happen. And that's why even his Republican Congress isn't paying attention to it. Now, there are many things in there among the 10 different points that were in there that might be good policy. I happen to believe that there is no philosophical or economic rationale for differentiating between the tax rate on earned income and capital gains. And if you go back to Ronald Reagan's tax reforms, the two converged. And that made sense. Now, there are lots of things we should do in terms of lowering corporate rates, eliminating a lot of the deductions that don't make sense. We can do things that will generate capital formation, bring capital back, simplify the code. All of that would be good for the economy. But anybody who is investing based upon the notion that there's going to be a 15% pass-through, and suddenly, therefore, you want to buy particular assets, you're going to be waiting for a very, very long time before that's a reality. I hate to say it, but the tax policy of Donald Trump, like virtually everything that has come out of the White House, is chaos, built on chaos, built on chaos.
I'm going to let you counter that.
Let's vote for Eliot one more time.
Well, look. Who knows whether it's going to get passed or not. I think that the fact that there's a Republican House and Senate and the plan for the Republican Congress before there was a President Trump was to lower our indexed on individual income taxes, as well as lower the corporate tax rate and reduce capital gains to incentivize investment. So whether we get 15% or what, we will get some form of tax reform. Or there will be a Democratic Congress in 2 years, or less than 2 years. Right. But more likely, there will be, given there's a Republican president and there's Republican Senate and House, and there's no real independent voice there on the Republican side to challenge this process. And also, I think they're all in favor of it. I think that we will see some tax reform. I think we'll see it most likely in this Congress before the end of the summer recess. And if not, it will be toward the end of the year. And look, I speak with some authority on this. I chaired the Congressional Black Caucus Foundation Board for 2 years, which is a think tank for the 50 African-American members of Congress that make up the largest block of the caucus. And one thing, Eliot, that just to remind you that the Congressional Black Caucus did is when George W. Bush wanted to eliminate the estate tax, the Congressional Black Caucus left the Democratic caucus to vote on that. So I think that there's going to, and that's another thing that's coming too, is estate tax reform. So there will be no need to have these complicated trusts and so forth. And by the way, I think that's a good thing. I think we can all agree that—
They're not so complicated.
Pardon me?
They're not so complicated.
Well, they're pretty complicated. You got to pay, 50% again after someone passes their income, and the question is, who does that benefit and who does it hurt? And so anyway, I think that we're going to see some tax reform. It is going to be the topic of discussion once they finish up with health care and finish along with this investigation of Russian involvement in the election.
Can you tell from the panel who is considering a mayoral run? It's a pretty interesting—
Eliot Spitzer.
Toby, I want to focus on the Trump question, but maybe zoom out a little bit. We've talked a little bit about tax reform, but in general, what is your thought on where this administration is going to take the market? New York is typically a game of city and state, but the rhetoric, a lot of the things that you've discussed before, do you think they're going to play on the market in any way in the next couple of years?
So, I think there's, people sometimes miss the roots of the story of New York's transformation and in particular Brooklyn's success. And I believe that it started with Mayor Bloomberg after 9/11, when he made a very aggressive push to bring the technology industry and the creative industry here to New York, and effectively ended up filling buildings that nobody wanted to be in. And as the financial services industry pulled back, that became, Google went from having a location to having really a headquarters and all the other companies. And right now, New York surpassed Boston as the #2 in terms of volume of venture capital dollars. And a big piece of that is what I feel is the immigrant story. I'm the daughter of an immigrant. My father was born in a German DP camp. My grandfather was an immigrant. He came to this country. He was almost 50 years old. And I think, the not continuing to recognize the economic transformation of New York that was built on the backs of immigrants, and the employment, and whether it's people starting their own businesses, running a local bodega, or workers coming in, high-skilled workers coming in. So I think it's very concerning to listen to that piece, the transformation in New York, which trickles down to people buying, Ben's apartments, and people renting my residential buildings, and entrepreneurs starting companies, moving into Bushwick, and then all the money that flows along with that allows people to get rich, and really brings wealth and economic transformation deep into the urban infill in the outer boroughs. That needs a constant influx of people. And I mentioned when I was on the call, I was traveling in Eastern Europe with my family. We went back to Poland to see where we came from, and I stayed online to get through passport control for over 2 hours, and that was ridiculous. So, I also own a hotel. We want to be a welcoming place. We want to be a place the brains around the world continues to come to study at our universities. A lot of money is being invested in downtown Brooklyn. That requires a constant flow of immigration. So I think that's, that's very concerning.
Eliot, on the city and state level, sort of the dance between the mayor and the governor has been a historical one. Sometimes one's on top, sometimes the other. There's always some words exchanged. There's always some maneuvering. However, in my memory, and I'm relatively, I'm quite young, but in my memory, it hasn't been this acrimonious in a long, long time. The mayor and the governor have refused to see eye to eye on anything, have refused to come together on almost anything. How do you think this is impacting the industry, and what should they be doing about this? Or what should the industry be doing about this?
Well, Look, I think you're correct. I mean, this is, having been on one side of that equation, I can tell you when I was governor, Mike and I got along great. Didn't agree on everything, but we never publicly feuded, and our notion was we're both working for the public. We are trying to resolve policy differences as best we can, and we approached it that way. I think what we've seen now is a bubbling over of personal animus, political tension, perhaps because they're both in the same party, and frankly, an internal fight within one family is often more bitter than a battle between two parties. Mike and I suppose technically we're in different parties, but not really. I say that because he was a Democrat, just so it's clear. But I think what you need is some grown-ups in the room. I think you need some grown-ups, the elite. Back when New York City was going bankrupt, the business leadership, the labor leadership, the civic leadership got together, sat down and said, here's how we're going to resolve the financial crisis of the city of New York. I think at this point in time, on some of the issues between the city and the state, the New York Times just this morning posted an article about the MTA. The subways in the city are falling apart. The MTA is run by the governor. The folks who run the city of New York, the mayor, the business leadership, the union leadership, should sit down and demand that the state put the money and the capital into the MTA that is needed to maintain the system. The mayor can't do it alone, but the governor's not listening. And so what you need is greater civic engagement. You have two individuals who will have to work out their personal, maybe they need group therapy, but I don't think it would work. But you need the civic leadership to get engaged.
But John, you have an industry that has money and has political clout. Is there anything that they can do to intervene and maybe fix this marriage a little bit?
Well, first of all, I think what's happening in Washington, you have the non-politician as president. I know Donald Trump through New York for 30 years. We've never done business together. We've done some charities together. And the one thing that came out of Washington versus the days of President Obama was optimism. The banks no longer consider, Washington considered the banks as enemies, or the banks considered Washington as the enemy, because they would get fined, they would get punished, sometimes for no reason at all. So when the banks get fined and punished, they shut down the doors. Guess who doesn't have the ability to borrow as much under that scenario? Every business person in this room. I was a high-level credit. I could borrow anytime I want. But the people that are clapping for the old Washington, you couldn't borrow as much as you want because the banks weren't lending. The business people were considered enemies. So optimism, you have the stock market went from 18,000 to 21,000. $3 trillion in wealth was created because they felt that the banks are going to be able to lend, the business people would have the optimism to create the jobs, and we were no longer the enemy of Washington. Guys, get a reality check. That's the real situation. And what's needed now is to complete their job. Obamacare was the worst thing that happened to our country. It took care of certain people, but it hurt a lot of other people.
John, I do want to bring this back to real estate. What can the industry do at this level?
Otherwise,
we're going to be here all day.
Because it goes back to where do I invest? We have a choice of investing. We're a very diversified company. I could put my money in bonds, I could put my money in building new buildings, or I could put my money in Florida. So you have a choice. So back to real estate, I think that the optimism And I think New York is the headquarters of the world. Miami is the headquarters of South America, and so on. If the incentives are there to create the jobs and invest, we will invest.
I want to pivot off that. We talked a little bit.
But I would like to respond to that.
Which one? Which part?
Respond to what you want, but the truth is the truth.
I just want to
There's
just
going to be
say
a mayoral
something.
debate next week that The Real Deal's hosting.
Yeah.
The what?
Okay, I just want to say, wait a minute now. Barack Obama about optimism. Well, wait a minute. Hope, change, yes, we can. That's not optimistic. Build a wall, throw them out, lock them up. That's optimistic. You know, wait a minute. So the financial services industry worked for a small number of people, a very small number of people, and then Barack Obama came into the country and he saved this country. He saved it from financial ruin. He restored confidence. I'm not done. He restored
I'm going to bring this back to real estate in 10 seconds.
He restored confidence in our banking system. He brought back order to it, and now it's time for a change. And now we have one. And I'm not sure, but 88% of this city didn't think that was the right change to go to. Now, I happen to be a business person, and so we're doing business in the United States. And so, yes, we have to do business with this administration, and there is a sense of some form of optimism on the stock market. But we are concerned about international travel, international investment, how our global partners are going to look at this country. When I was in China, they were worried about their investments in this country. And so now is the time for all of us. You talk about responsibility of the business industry. All of us are responsible now to start holding this president accountable as well, and to say, look, this is what we can do, and this is how we do it. And by the way, New York, the city of immigrants, the most diverse city in America, welcomes everybody.
I am an immigrant, okay? I am an immigrant.
Toby, I'm so glad you're sitting between them, I have to say. I'm going to bring this, there is a lot of room for statements, and maybe this is not the forum for them, but what I do want to talk about is the financing environment that we're in right now. So John brought up the banks and maybe losing a little bit of faith. All of you sitting here have managed to pull together money for your projects in an environment that's extremely tough, and I'm talking about very, very ambitious projects. Toby, you had close to 200 million at 25 Kent. Eliot, you had 330 million at 420. And you had, I got 197 million, is that the right number? Something like that.
And what?
But how did you get that money together? What do developers have to do differently? Are you accepting a higher cost money to make this happen? Ben?
The answer is yes. We are accepting a higher cost of money. I think that our focus right now is not only finding lenders, but also finding the right lenders for the right projects. I think that the commercial banks are out of the market right now for condominium projects. They're still very much in the market for rental projects with the right basis. For us, we prefer to shop our debt in some of these funkier single stack lending pools where we can go to a Blackstone or to a Starwood or someone like that and borrow money from one person and just deal with one institution through and throughout the entire project. The smaller projects are still financeable up to about $50 million with one lender. Our projects are a bit larger, and we're borrowing $200, $300, $400 million at a time. And for those projects, we prefer to go to one lender or a pair of lenders who work together in sequel. That way, if we need to modify something down the road, we can talk to one person or two people, not to 10 people, where historically, in the last recession, when trouble occurred, it's very hard to get the consensus of 8 different lenders. Much easier to get the consensus of 1 or 2 lenders on a project.
Eliot,
well, look, I think the ratios are different than they used to be. There's a greater expectation, as there should be, that there's more equity in every deal. And that's a good thing. because we lived through a couple go-go years where there was virtually no equity involved in transactions, and it led to a crisis in 2008 that had many causes, but that was certainly one of them. So greater equity, valuations are more reasonable. We have always built, for 50 years, my family's built rentals because we have a time horizon that almost goes on into perpetuity. So we're not doing condos dependent upon timing a market that says we're going to sell in 3 years. It's a very different equation. And so in that context, yes, we're able to get financing, but I think lenders are being more rational, and that's a good thing. And I think this goes to both what John was saying and what Don was saying. I mean, yes, the financial services sector made some egregious errors prior to '08. We put in some changes that were necessary. I mean, you may remember when I was AG, I dealt with a few of the banks. And some of what they were doing was wrong. Some of it's been corrected. Some of it has changed. And the consequence is we now have a system where hopefully equity will flow in the right ways. There are also non-bank lenders who are willing to take greater risk. And so you cobble it together, but more equity, better valuations, more fundamental analysis that is correct, and the market will stabilize.
Did you go with, for your project, you went with Starwood?
We ended up with Starwood, and they're a pleasure to deal with.
Did you try sort of the roster of conventional banks?
I'm not going to get into more details than that, but I like Barry. He's good on TV. I said I'll borrow from this guy.
Okay. Toby, you had probably one of the most challenging projects. You're building a spec office project in Brooklyn, which is still a relatively untested product at that size. How did that process go? It took a while, but you got it together.
So, I consider myself the venture capitalist in the business, and generally always face the Gordian knot of financing. When there are comps there and banks are willing to come in, you're paying a price that doesn't work to take the kind of risks that I've taken. So, for example, at 25 Kent, we started out with money from private funds during the very high-risk period when I went through a rezoning, and then ultimately brought in a partner, Rubenstein. They've built millions and millions of square feet, and with them, once we finished the rezoning process and had that risk taken off the table, you managed to bring in the financing. I think we're one of the few buildings to be financed, speculative, office ground up, and we just poured our foundation. So obviously there are a lot of new entrants into the market. More typically, 25 Kent is a very unique project. I see my architect there in the audience, Matthias Holwich, great design architect. Beautiful building and waterfront property, and ultimately got ourselves to a great basis with the rezoning. But generally across the rest of my portfolio, and I'm sure many people in the audience, there are a lot of exciting new entrants into the lending market. Slightly more expensive, but there are many ways to mitigate that with other deal terms that bring speed to the table and allow for de-risking. And I think that it makes it more challenging to finance a project, but at the same time, there are more opportunities for creativity and for developers to think out of the box, go into neighborhoods that aren't obvious with asset classes that haven't necessarily been built in those neighborhoods, and this is a moment to do it.
Is there some anxiety there, though, because you're building a product that is looking to attract, I'm assuming, some big tenants? Brooklyn really hasn't had the kind of magnetism for office that one would have hoped by now. I think we worked at a 200,000 square foot lease last year, but since then there hasn't been anything of any sort of magnitude. Is this a concern?
So, I think you really need to look at the overall possibilities and options for tenants that even want to relocate to Brooklyn. And historically, outside of Dumbo, which Dumbo is running at a tiny vacancy, other than the stuff in Dumbo Heights, there really hasn't been real estate options. So
but we're talking about 7 million square feet of office hitting the market by 2020.
It's very, very, I think you have to really look at each neighborhood. A tenant that wants to be in North Williamsburg is not contemplating downtown Brooklyn. I have a building in Bushwick. Most of the tenants in that area, in Bushwick, East Williamsburg, the owners or entrepreneurs live somewhere along the L line. They're living in Williamsburg. They're biking to work.
Oh, the L train. Did you say the L train? We're not allowed to swear on this. It's going to run inside
of Brooklyn, but that goes back to the MTA discussion, which will come up again. So it's really very, very specific. When I opened my office in Manhattan, and I've now relocated to Williamsburg, I live in Queens. I drew a little circle of the E and the F stop, the first one in Brooklyn, in Manhattan, and I told my broker, find me an office there. And that continues to be a critical influencing factor in the companies looking for space in Brooklyn. I think some of the owners are unrealistic about the size of a typical tenant. And it tends to be smaller growth capital companies. So these are our typical, the tenants in our building in Bushwick and the tenants that we're speaking with for some of our space that's going to come online soon are typically taking 5 to 20,000 square feet. These are cash flow positive companies, some of them venture backed. there aren't that many 100 to 200,000 square foot tenants. But coming back full circle to 25 Kent, I think Williamsburg is about to be transformed with our 500,000 square feet and the Domino Sugar Factory, which is also coming online. And it's right in the heart of a very educated employee base. And what's driving interest from those tenants are the people who live in the neighborhoods, the people who maybe work in some of these companies, and that's going to continue to drive. So I would lump the millions of square feet coming online in downtown Brooklyn with the other parts of North Brooklyn.
Eliot, you're hoping for her project to be a success because that means tenants for you. But any concern about the rental market? We've been seeing a lot of stories about the rental market softening. There's been incentives, there's been concessions. A lot of brokers in the audience, they've had to go back to their landlords and say, look, we're just not able to lease up at the speed that you'd like. You're building a project that is, that scale hasn't been seen in that area before.
Well, first of all, let me say that Toby and I have a huge investment in Kent Avenue together. She's at one end, I'm at the other. You have
3,000 new employees.
Well, you have 400,000 square feet of office space. I've got 800,000 square feet of rental space, 857 units. Look, we both see in Williamsburg a transformation that began many years ago. And as you say, it is the story of New York. And it is a remarkable story. It continues. And so I have confidence not only that it will continue, but that it will continue to increase and accelerate as time goes by. If you build rentals for a 30-year, 50-year time horizon, you don't worry about the momentary ebbs and flows. You don't worry about 6 months it's going up and then it drops 2%. What you worry about is what Don and John are both talking about, even though they seem to disagree. We are a city of immigrants. As long as immigrants around the world want to come to New York, as long as every college kid in the United States graduates and wants to move to New York, then New York City will prosper and thrive. The businesses will be here, the intellectual capital will be here. If we invest in housing and transportation, education, we'll succeed. That's what we're doing, and that's why I have enormous confidence in Williamsburg and the entire Astoria is going to be next, then the Bronx. It's going to be an amazing story. So I don't worry one bit about it takes 6 months or 9 months to rent up. My great-grandchildren will look and say, gee, he was smart to build that building.
If your timeline was 5 years, would you be worried?
That's why I don't invest for 5 years. That's honestly why I don't do 5-year partnerships. I don't do the LPs that say we need to cash out. Whenever I see a prospectus that says in 5 years we cash out at 18.3 IRR and the interest rate in 5 years is going to be X, I throw it in the garbage. I say you have no idea what you're talking about. Nobody can predict to that degree of specificity.
John, same question for you. You're also building pretty big projects, Myrtle Avenue. What's your thought on the rental market and in terms of demand when it comes online? Your product's coming online this year or next year, right?
No, I agree with Eliot. There is stuff coming online. Right now, our rentals, we're doing a big rental projects on Myrtle Avenue in Brooklyn. Brooklyn is a great place. And we're just about on schedule. We're maybe 30 days behind. But we're in the investment business. 30 days doesn't mean anything. It's just a matter of time. We don't have to worry about making our next interest payment because we're in the money business. I think Brooklyn is the greatest, it'd be the third largest city in the country if it was a city in itself. Chicago dropped off. They murdered so many people, it's gone.
So John is no longer running for mayor.
The fundamental thing in New York City is we maintain our lifestyle, and people, all the college students are moving in. 700,000 college students in New York. You have international people moving in, and there's Manhattan, and there's Brooklyn, there's Queens, and now I think the Bronx is going to start to come back. It's got a great transportation system. So when you have a good transportation system, the Bronx, if they keep the areas safe, number one thing, whether you're rich or poor, safety is the number one. People have to feel safe. And then the number two, transportation. If people can get to their jobs and get to any other place in New York, safety, transportation. If New York maintains it, greatest city in the world.
Ben, out of all the developers here, you're perhaps most exposed. Maybe you wouldn't use that word, but in terms of the condo market, you've probably got the most prolific pipeline, let's say, of condo product out there. How are you feeling about the condo market right now? There's been a little bit of a glut on the very high end, but this year we've seen a lot of transactions. As Howard and Pam were talking about earlier, things are selling at the very top. You've got things in every price point, hence your talk about diversification. How do you feel about where you are with sales, and where do you see the sales going in 2020 when some of your product is coming online?
I think the market is actually very stable right now. I think the press needs to calm down a little bit and stop predicting that there's millions of apartments coming online and that sales have been terrible. And I think the politics of this country have kind of fallen into our lives, and as owners and developers and as brokers for all you guys who are here, or some brokers who are here, the city of New York is a very safe place, and Manhattan is probably the best city in the entire country. People want to move here. Now, whether they can get into the country or not is a different story. That will kind of work itself out over time, but people are still coming here. There's jobs growth. We are selling apartments. We had a great January, February, March. April was solid. December was decent. People are still buying apartments, and if you're priced at the right price point, and you're not trying to cover up your construction cost overruns or trying to squeeze your LPs into being the promote by raising the prices. If you're priced to sell at the right value, you will sell your apartments. If you are living in a delusional world and you want to continue to raise prices and go on to your 37th price amendment, it's not going to happen for you. I think it's our jobs as developers and the brokers' jobs to paint a fine picture, which is not hard in New York considering what's happening in the rest of the world. I mean, if you look around, this is still the best place in the world to live, and people are coming here in droves. The Chinese have not left the market in New York. They're still here buying apartments. It takes them an extra month or two to move their money out of the country, which is fine. The rules and regulations on China have opened up in December. You have money coming in from Brazil. You have money coming in from South America, all over South America. You have money coming in from Canada, believe it or not. I have some buyers coming in right now. The money is out there. This is the easiest place to sell apartments in the world. If you think it's complicated here, go try to sell apartments in Turkey, where you have a country that's about to fall apart. So, things for us have been fantastic. I mean, I wish I could continue to raise prices and make bigger profits, but we bought our real estate the right way. Our sales in the 1 to 3 market have been fantastic. Pretty much anything under $10 million is selling very well. We don't have exposure on the upper $6,000 per square foot.
There is one apartment you're considering selling for $75 million, unless I got that incorrect.
Yes, we are going to sell it. And
where would you be happy selling that?
It's a beautiful apartment. Our basis in the apartment is very healthy, and our sales in the building have been very strong. I think we've closed almost $500 million in apartments in that development, 100 Barclay. Where we sell it is where we sell it. It's our gravy. It's our icing on the cake on a great project. On the rental side, things have been very good. Yes, there's some flatness. Yes, there's concessions out there happening, but that's okay. As Eliot said, it's not a short-term game on the rental market. You buy assets, you build assets, you fix up assets, you improve assets. It's not a 5-year plan. It's really a 10 or 20-year plan, and as you said, Eliot, it goes to our children in the long term. There's no rushing.
Don, I'd like you to take that since you're also developing condos.
Yeah, look, I think that Ben's right, that there's been a lot of press about how there's this oversupply.
But press is based on public records. It's not just press. It's
I'd like you to show
prices.
I'm sorry. Please show me the public records, because your public records are coming from permits, and I assure you that those projects are not being built right now.
That is a good point as well. Go on.
Thank you.
I'll ask you guys this again. I'm going to follow just one more, and then you can answer this too. Is there room for a 157 or 432 Park in today's market or in the market of 2020? Is there room for a Central Park Tower?
Well, I think, first of all, look, there's not an oversupply of condos in New York City. some condo projects are priced aggressively. There's a shortage of housing. There's an imbalance between supply and demand. It's all now about affordability. There's more demand than there is supply. There's just a challenge of affordability. One of the things is New York City, Manhattan in particular, is the strongest market in the country. We're a national developer, so we've got projects in Boston, Philadelphia, DC, Charlotte, Miami, Los Angeles. So we're seeing the condo market on a national basis, and this is the best market in the country. So one of the challenges, though, is it's going to take a bit longer to sell condos now. They're not going to be, because there was this pent-up demand. When, after the recession, nothing got built, there was a pent-up demand, and finally things started getting delivered 2012, 13, 14. It's like taking an inflated ball, submerging it underwater in a pool. Once you let it go, it pops up, but then it levels off to its own equilibrium. So we're getting into a more healthy market today, and there's not this sense of urgency as much for people to buy pre-construction. We're building 108 Leonard right now, and that is a conversion of the original New York Life Insurance Company building. It's about a 430,000 square foot building, $500 and some odd million in cost, and it'll sell out for close to $1 billion. And we're optimistic about that. The financing, the lenders on that project, we use traditional lenders, a relationship lender, Bank of America, who's financed for us for well over a decade, and then some mezzanine financing from Apollo. Again, another relationship that we've had. I've talked to our bankers and a couple of our members of our syndication of the banks for that project, and they're now back in the market, beginning to look at condos again after pulling back. Do I think there's room for more $100 million apartments, more 10,000 square foot apartments? Not really, because there's only so many people on the planet that can afford to buy it. You know, up here, Eliot and John can afford to buy them, but, you know, I can't, and I don't know about Ben, you know, and I don't know about you either, but I'm working for me right now.
Speak about John, not me,
my kids will figure it out. So, but I don't think
we can afford it, and we don't spend that much, do we, Eliot?
Right. So there you go. So there's only so many people buying those. So I don't think there's room for much more of those. But I think where our industry is going to look toward the future is how do we solve this affordable housing? You know, Eliot worked on that as governor. How do we deal with the growing number of New Yorkers that can no longer afford to live in the city? And so while New York City's population has grown, New York State has now become the 4th largest city from the 3rd largest because it's been usurped by Florida. And that's, again, because of affordability and quality of life.
I do want to bring it back to affordability in a second, but Ben, to your point, if it's about pricing and if it's about sensible pricing, what do you tell the brokers out there who've been used to, for the last couple of years, selling at top dollar, selling, you know, these exuberantly priced apartments and making those commissions? Because now commissions are going to drop. Things take longer, but they've still got to make a living. So what do you do?
I don't feel bad for the brokers at all. They're doing very, very well in this market. We take all the risk, and if they sell an apartment for $1 million or $1.05 million, their commission, the delta is very, very small. I will tell you that, I'm losing my train of thought. The market is solid, and the supply in the market is going to be gone very soon. I am out there, I'm looking for property and land to buy every single day. There is nothing trading. There's nothing coming online. There's nothing happening. This product right now that's out there will be gone in 6 months. And there will be some projects coming, spurt here, spurt there, but in 12 months from now, there will be no supply left in the market in the $1 to $10 million range.
One of the things that we've been talking about is affordable housing. One of the programs that is supposed to spur the development of affordable housing is 421A, which is now back. It's been called Affordable New York, but basically the same thing. A couple of big changes. Eliot, you had talked about this not being a silver bullet for the industry, not being a silver bullet for housing. What else should New Yorkers be doing? What else should the city be doing and state be doing to encourage the development of affordable housing?
Well, look, I think Don is correct. I mean, the inputs, and we've all been saying the same thing: transportation, safety, education, housing, and then a city will thrive. Unique in New York City in particular. 421A is a fundamentally flawed program. When you step back and say to yourself, what is its purpose? If the purpose is to incentivize the creation of rental housing, and then you look at the cost per unit created, you say that is a crazy number. If you say the purpose is to create affordable housing, the cost per affordable unit is also off the charts and makes no sense. If you, as somebody who when I sat in the executive chamber said, why are we doing this? I said to myself, the better way to generate construction of affordable housing is either for the state to use the lost tax revenue from that program and actually build the affordable housing, which we can do at a much lower cost point per unit, and then we'd actually own it, than to have the 421A inclusionary units, or even better perhaps, build transportation. And this comes back to what we were all talking about before. And when John said, why is the Bronx going to thrive? It's because it is a transportation system. If we extended the subway systems, the bus systems, the above-ground transportation systems into new communities, then the amount of private capital that would flow into those communities, you upzone and build transportation, then the city will explode with housing. That's what we should be doing.
I agree. I agree 110%.
I agree.
You know what nobody talks about, guys? We talk about affordable housing. I don't give a darn affordable housing for people that get on a bus from South Carolina to come to New York and they want affordable housing. I don't give a darn about those people. You know who I want affordable housing for? Our cops, our firemen, our teachers. I want them to live in New York City and not live in Timbuktu because they can't afford that kind of middle-class, affordable housing. And nobody talks about that. Everybody talks about affordable housing for the ultra-poor. They deserve it too. But how about our middle class? Let's vote for them too.
I think tying in, Eliot's comments and John's comments, and I've heard some of, the industrial advocates in Williamsburg use the phrase, no housing is affordable without a job. And I think it's really critical. You ask, what the city can do, echoing Eliot's comments, as people start to think about working outside of Manhattan, I think it's really about making sure that the pieces are in place, whether it's through zoning or very critically, you talk about the L train, transportation. It's no longer about trying to be in Manhattan, live in Manhattan, work in Manhattan. We need to make sure that the infrastructure is there so people could live, work, and play anywhere, maybe eventually even in Staten Island.
Mm-hmm. Eventually.
Yeah, I would say, look,
you need a transportation system for Staten Island, and nobody's working on it because look, I have employees that live in Staten Island. Very, very hard for them to get to work. 2 hours in, 2 hours out is not a way to live. We need for Staten Island to work, need a transportation system for Staten Island, and there's no Robert Moses around anymore to figure it out.
Look, I think affordable
John,
housing.
we have you.
Affordable housing is in tiers. We have low-income housing, workforce, middle-class housing, and then those that are of our new generation of workers that we're trying to maintain, attract, and keep them here when they graduate college or they come here to seek, their fortunes or seek their careers and build their careers. And they're the ones who are going to keep all of our industries going. And so we can't have this lost productivity like John just mentioned. Police officers driving 2 hours to and from work just to maintain a quality of life for themselves and their families and putting their lives on the line. So the idea is that we need to have better productivity. If we can keep people out of their cars, make the commutes shorter within where they can live and where they work, we will have a more productive economy as well. And that's a big economic issue. And we shouldn't be looking at it as, well, we're going to provide affordable housing. No, we're going to make the city more efficient. And the way to do that is to be able to have housing stock that meets those things. And the government's 421A plan doesn't accomplish that because it's really focused on providing tax abatements by and large to justify the construction of rental housing, because otherwise building new rental housing for, say, a 10-year horizon is a lot more challenging.
And the translation to that is what I talked about in 2013 when I ran for mayor. Transit-oriented development. The Bronx, Brooklyn, Queens, we have $1 trillion subway system that can't be replaced for even $1 trillion. Let's use that system and upzone the areas around those subway stations and create middle-class housing for those people and affordable housing, and be able to have some place for people to live and not having to have them move out of our city. Let's create a tax system where people don't have to move to Florida. And let's figure it out.
Let me ask a rhetorical question. If you look back at the way the 421A program that was just adopted was drafted, and remember that the current governor asked Rebney and the trades to negotiate the bill, and then ask yourself, if those two interest groups are going to negotiate and draft this bill, do you really think it's going to generate a bill that produces middle class and affordable housing? And the answer is of course not. These are the two interest groups that want to maintain the value of property, drive property costs up, and drive up construction costs. So there should not be any surprise out there that 421A simply does not accomplish the objective that it should from a public perspective. And John and Don are exactly right. Transportation, safety, and transportation.
Affordable housing, transportation, safety, these have been issues that have been part of the narrative for the last decade and a half. However, under this mayoral administration, the criticism from the real estate industry has been more and more and more harsh. What is the reason? Is he just getting something wrong in translation? Or, Don, why don't you take that one? Because you had some thoughts on it. I'm lobbing you this one.
Well, look, I think that, you know, it's frankly, and I mean this in the kindest way I can say it, is about qualifying. Bill de Blasio was a public advocate before he became mayor. He ran a budget of about $1.2 million a year and 12 employees. And now, to give you a context of that, the average Dwayne Reed store in Manhattan grosses $7 million a year and has about 60 employees. So a Dwayne Reed store manager was 6 times more qualified than Bill de Blasio to run the city. And so the public, in its infinite wisdom, this dumb person included, supported him to run a $325,000, $82.5 billion government. And we're kind of surprised that he didn't do a good job. So I think the part of it is competency. And I think that, you know, managing a large business like John does, managing a large business and a state like Eliot does, managing our businesses, that produces a different skill set. And I think that that is part of the problem. And then also, big ideas, you know, you get 1 to 2 of those, not 100. And so it's the small fundamental ideas like, how are we going to deal with affordable housing? Well, this mayor looks at it as a soundbite. Preserve, maintain, and build 200,000 affordable housing units over 10 years. Now remember, the operative word is preserve. So what's the plan to have a meaningful affordable housing program, or sitting down and exercising leadership? What Eliot pointed out about the 2 parties negotiating 421A. And I think the other thing is about, look, weakness. Some people, you know, capitalize and they go after weakness. And I think that the governor sensed weakness, and he chose to take over and look, we have now state troopers patrolling New York City. So I think it's leadership, competence, and a vision to do the fundamental core duties of running and managing a 325,000, now 350,000 employee government.
You run a company that's slightly bigger than a Dwayne Reed, right? Are you going to run for mayor? Is this the time to say something about it?
No, it's not the time to say something about it. I run a business, it's about a $3 billion business, and we do business around the country. Look, I think all of us, I think the business community, the challenge with us in real estate, for example, and all of us know this, is that we're reticent to criticize because we have to go to this very same mayor and this very same government to get our ULIPs, get our projects approved, get our building permits, so we're all kind of afraid to challenge him. So how my discussion about running for mayor came up is I was frustrated, just like all of us. And I spoke out about it. And so I think the business community, we as a whole, need to step up and start challenging this process and start solving the problems ourselves, not deferring to some politician who won a popularity contest in a crowded election.
That implies the federal level as well, I'm assuming, you're talking, right?
Well, no, I think the one thing that the country did do is they said enough of career politicians, and they elected a businessman. The first time we've had somebody who's never held elected office before, he became president. And that was because Americans said enough of the political correctness, enough of the career politicians. We want somebody who has built a business. So like him or not, the current president has built a business and understands how to run things. And I think that's what the country's looking for. And I think New York is as well. We want some real solutions, not rhetoric anymore, not sound bites.
Eliot?
I was just going to add, I'm going to say something that may be unpopular, which is to defend Bill de Blasio on one point in particular, which is that he has agreed with much of what we've set up here, in particular about upzoning. He has tried to upzone many communities of the city, and what he ran into was the buzzsaw of local politics. And when you try to upzone in many communities around the city, what you see is a fear of gentrification, local opposition, local community council leaders who are opposed, and it's a very tough thicket. And so at that level, again, I'm not justifying the outcome, I'm not justifying many other aspects of his decision-making, but I will say that he has at least confronted the reality that we do need to upzone. And to go way back to a different moment, what converted Times Square from the mess it used to be to its now center of being perhaps center of the universe in many respects, was Ed Koch's decision to upzone Times Square. That was what permitted the infusion of capital there. So it works, but it's very difficult, and so it is not something that happens overnight.
Right, but it does require some leadership, and leaders generally create consensus, not follow it. And I think the challenge that we've had here is, yeah, Bill de Blasio has been supportive of upzoning Midtown East and some other areas, but he's not used his bully pulpit to get it done. Good ideas that lay dormant on a desk or in a drawer or an idea do nothing. It's getting those ideas implemented, and that's how you measure success. If we all came and dreamed of big buildings and never built them, we wouldn't be sitting up here today. It's execution, not ideas.
I want to just ask one final question. This is, a room full of brokers as well as developers, some who are starting out. And what is the mistake that you're seeing young developers make today? Or how have you seen developers get burned in the past? And maybe you can share that with them. Ben, we'll start with you.
Take less leverage.
Have people been getting burned on that recently? Have you seen people go in and make these purchases and now are in trouble?
It's an up and down market, real estate, and it's good some days and it's bad other days. And if you have a lot of leverage, you're going to pay for it, and it's going to hurt you long term.
Don?
I would echo that, but I would add also own most of what you build. I think that if you own a small amount and wait for a promote, then you're really working for someone else. If you want to be an entrepreneur and you want to be successful, you've got to own a significant amount of what you build.
Toby, you came into the business sort of in a sideways way where you had come in to invest other people's money. You saw an opportunity in distressed Williamsburg and you kind of worked your way up from there. What is your advice to a young developer today? Where have you seen people go wrong?
So I've given a talk which I call How to Survive as a Man in a Woman's World. And it's basically, I've given it to male audiences, women audiences. It's really about learning how to own your skills, own who you are, and maximize that. So, I think that will play itself out. And in my career has shown that experience is important, but thinking out of the box and being innovative, which sometimes is contradictory to experience, is equally as important. So for a young developer, it's going into a new neighborhood, it's looking for a new way to finance when the banks aren't obvious, and when things are difficult like they are in a moment like this with a lot of uncertainty, where hard work and sweat equity is critically important, as is being innovative. It's a great moment for someone to break into an industry. So lack of liquidity, other challenging regulatory environment, it's a great moment for everybody to try to find a new way to do business.
John?
You're better off doing something that you could handle versus over-leveraging, where if you make a little bit of mistake, you're not going to be taken out feet first. So do the next deal something that you're not going to be over-leveraged and you're able to handle. I think it's the most important lesson you can learn today.
Eliot Spitzer.
I think we're all saying the same thing. It's not so much the price you pay, it's your capital structure. Be equity heavy. Leverage is a narcotic. It is dangerous. It will kill you. and read a brilliant little book written by John Kenneth Galbraith called A Short History of Financial Euphoria, written many decades ago. It summarizes all this, and if you read that and understand it, you'll be a huge success.
If anyone needs any equity for any deals, any young developers, call us. We're happy to talk to you about any opportunity you guys have. Our doors are always open.
If Don and John want to continue the debate at TRD's offices next week, I extend an invitation right now. I'm sure a lot of people will show up. But for now, I just want to thank our panelists. Thank you so much for being here. Thank you. And thank you.